While the markets cheered the Fed's decision to pause interest rates last week, all I can say is it's about damn time. The Federal Reserve has raised interest rates 10 straight times over the last 15 months prior to Wednesday's meeting, and it was a total of 5 percentage points, bringing the Fed funds target rate to 5 to 5.25%. The big question, though, going forward is this the end of the cycle, and where do we go from here? But before we get to that, I would really appreciate it if you hit the subscribe button and the like button and tell your friends if you find this material interesting. Now let's get back to it. So as we mentioned, the Federal Reserve has been aggressively hiking the federal funds rate for the last 10 consecutive meetings prior to last Wednesday for a total of a 5 percentage point increase. And this is all to fight inflation. Inflation peaked last summer at just over 9% growth rate, and they desperately want to get it back to their target rate of about 2%. Now, the funny thing is, do you recall back in early to mid 2021 when Fed Chairman Powell said that the inflation was only temporary and would be waning, and they didn't want to cut off the economic expansion by increasing rates early? Well, that policy was moderately quick to change with the start of the rate increases in March of 2022. And as we mentioned, it was the most aggressive rate increases in over 4 decades. So what was the change? Well, to answer that, first we have to explain what demand pull inflation is. It is too much money chasing too few of goods. And that is caused by an increase of money supply. Now, how do we increase money supply, and what exactly does that look like? Well, historically in the US, money supply has grown by about 7% per year. But over the last decade, due to quantitative easing, the money supply has actually grown at double that rate, at 14% a year. What exactly is quantitative easing? Well, quantitative easing is a means of the central bank or the Fed to inject more money into the system. They do that by going to the open market and purchasing securities such as bonds and mortgage-backed securities from banks. That injects more capital into the system. The banks are then free to in turn lend out that capital, and it puts more money into the system, thus increasing money supply. Now, if you stack on top of that the COVID relief that the government injected into the system, that increased the growth of the monetary supply up to an astonishing 27%. So all of this funds that were injected into the economy made too much money chasing too few goods. Thus, inflation started to increase, and while the Fed initially thought it was only temporary because they thought it was due to supply constraints throughout the system, they actually were behind the 8 ball in getting ahead of the real inflation that was going on. And in fact, they continued quantitative easing all the way up until March of 2022, which coincides with the same time that they actually decided to raise the funds rate for the first time. So the Federal Reserve has 2 main levers of fighting inflation. One is to increase the short-term interest rates by increasing the federal funds rate, which they can do directly, which increases the borrowing cost between banks. And number 2 is quantitative tightening, which is basically the exact opposite of quantitative easing. They started this rather than dumping bonds into the system. They just stopped actually going into the market and purchasing bonds. And they stopped reinvesting the payoffs of the existing bonds and mortgage-backed securities into the system. Thus, there was not the constant inflow of funds by the Federal Reserve into the open marketplace, which in and of itself caused some form of quantitative tightening. So now that the Federal Reserve has paused, does that mean we can celebrate because that's the end of the cycle and we don't have to worry about interest rates going up in the near term? Well, unfortunately, we have to say hold on for a little bit. And the reason is you have to look at what the Federal Reserve members said. And if you look at the notes, basically what they said is the majority of the policymakers still see 1 to 2 more hikes of a quarter point this year. So right now, if you look at the Fed Fund futures, as you can see here in this chart, you can see that priced in through the rest of the year is about a 50% probability of a quarter point hike, either next meeting in July or the following meeting, and potentially in both. So previous to this meeting, the Fed Fund futures were actually pricing in rate cuts later this year. Now that's almost completely off the table. And actually the rate cuts are not anticipated now until next year, growing to about a 96% probability of cuts by middle of next year. But in the near term, there still may be 1 to 2 more hikes. So why the pause right now? Well, the pause right now is because they want to take a moment and see what the data comes in over the next month. And essentially what we've seen is on the consumer price index, which is a broad measure of inflation, they've seen that it has been coming down, but it's not yet near their target of 2%. Right now we're at about 4%. And they actually are more concerned about the core CPI, which excludes energy and food. And that's up at about 5.3%. So that's a little more sticky. And so that's the reason that the hikes are still definitely on the table, because they want to see that come down. Now, what they're not really telling everybody is that a big component of that is shelter inflation. And the biggest component of that is actually rents. And as we know, rents are a lagging indicator. So what we're actually expecting is that the rents are going to show over the next couple of CPI reports that they are coming down on a year-over-year basis, and that it will definitely decrease that core CPI. But keep in mind, this is the Fed, and the pendulum swings too far in either direction. So they don't want a repeat of the 70s, and thus the potential for them to overcorrect or continue to raise rates is very high. Now, why don't they want the 70s? What exactly happened in the 70s? So during the 1970s, we did have runaway inflation, and a lot of that was due to the soaring energy prices, if you recall the gas station lines. Well, anyway, under then Fed Chairman Arthur Burns, he aggressively raised rates between 72 and 74, only then to turn around and start cutting rates right away. And what happened is inflation roared back, to the point where the new Fed chairman, Paul Volcker, had to aggressively raise the rates high enough that it caused not only back-to-back recessions, but it pushed the unemployment rate over 10%. So the current Federal Reserve is scared to death that we're going to have a repeat of the 70s, or they don't want to have a repeat of the 70s. So what they don't want to do is they don't want to cut too soon. And so the propensity for them to over increase is probably pretty high. Now, most people will tell you that our economy is nothing like what was going on in the 70s. But quite frankly, that doesn't matter to the current Fed, because they grew up in the 70s. They remember what it was like, and they do not want that on their watch. So right now, I would anticipate that we will get at least 1 more hike, potentially 2 more. And it's really going to come down to how quickly the CPI numbers and the other inflationary numbers come down, especially the core CPI. But also there's a couple other factors to keep in mind. And one of those is the banking system. Now, there's a lot been said about the banking system and the collapse of Silicon Valley Bank and First Republic and Signature Bank, but it's kind of already been forgotten very quickly. Now, these are 3 of the biggest bank failures in US history, and it's been all within this year. And all of a sudden, it's kind of no big deal. Well, I'm not going to get completely into why we had runs on those banks and everything, but there are other indicators that there is some cracks in the banking system, and a lot of that is due to the aggressive rate hikes and them holding a lot of bonds that are below par value because of those aggressive rate hikes. Now, that doesn't mean that all these other banks are going to get runs and have to sell and to cover deposits, but it is something to keep in mind, and is definitely something that the Fed is watching, because they don't want a crack in the banking system. And so that is something to keep mindful of. And we're not even getting into the whole commercial mortgage and commercial loan scenario and what's going on there. That's a whole nother discussion. But What does this mean for you? What does it mean for mortgage rates? And what about this possible impending recession that everybody's been talking about for over a year? Well, as far as mortgage rates and interest rates, I would continue to talk about watching the 10-year Treasury. Because as we know, the 30-year fixed rate mortgage follows the 10-year Treasury, not the Fed funds rate. And the 10-year Treasury has been trading for most of this year within a range. And that range is at about 3.25 on the low end and 4.25 on the high end, roughly. Now, it's gone down and tested that 3.25 a number of times while only testing the top end of the range roughly 1.5 to 2 times. But it hasn't been able to break because a number of reasons, but just keep in watch of that range, because if you see a break either to the upside or the downside, that's going to have significant implications for the 30-year mortgage. Now, in the meantime, the 30-year mortgage rates are going to continue to trade within that high 5 to low 6 range up to the low 7 range based on that 10-year Treasury, and for the fact that the spreads on the 10-year Treasury and the 30-year mortgage are much higher than normal at about 3%. And that's due to a lot of volatility in the market, the fact that the Fed is no longer in there buying the mortgage-backed securities, which creates less liquidity, and therefore it increases the spread, and a few other factors that we could get into later. But with the increased spread and the 10-year trading in that range, keep an eye on that. Now, as far as a recession, a lot of people are asking, are we going to have a recession this year? Will it be next year? Are we going to avoid it and have a soft landing like the Fed's been talking about a lot? And people keep going back and forth on this. Now, my take on it is that yes, we will see a recession. It probably won't be until sometime next year. And the reason I think so is a couple-fold. One is if you look at the inverted yield curve that's been inverted for over a year now, you've got a couple different curves you can look at. You can look at the 2-year, 10-year, which is the most common, and that's been inverted and at historic inversion for a long time now. You can also look at the 3-month 10-year, which is basically the same thing and just inverted a little bit later last year. Or as actual Fed Chairman Powell himself indicated, the 3-month versus the 18-month 3-month forward. And that also has been inverted. And he said that that is the biggest sign that he looks at for a recession. So all of these are showing recession. And keep in mind that since the 60s, every recession that we've had has been preceded by an inverted yield curve. Now, depending on which curve you're looking at and the timing, it can be 12 to 24 months ahead of time before we actually see a recession from when we get the inverted yield curve. So it could be next year, it could be 2025 for all we know. But the chances are fairly high on that. There's also a lot of other indicators. There's different red flags that people look at as far as manufacturing indexes and so forth. And I'll go into that in another video of all the red flags for a recession. But right now, all the flags are up except employment. And the funny thing about employment is right now, everybody's using that to say that we're going to hit a soft landing because the market is strong. The jobs market is strong. We are going to sail through this and be okay. Well, if you look at this chart, you can notice that unemployment hits a low almost every single time prior to a recession. So it's nothing new that we are at lows on the unemployment rate. I mean, it's typical in every other recession. So keep an eye, though, on that starting to move up. We saw a little uptick in the last report to 3.7%, but we're really looking at, the Fed wants it above 5, quite honestly, 5.5. But we want to see it start to trickle up on a continuous basis, not just oscillate. And then another point that you might want to look at is take a look at the yield curves actually flipping back to more normal. Because typically when we actually are entering the recession, the yield curve is going to flip at the beginning or right before we enter the recession. Now, I think the Fed will continue to raise at least 1 or 2 more times. I think they are trying to break the labor market. They would like to see us hit that 5 to 5.5% unemployment rate because they want to make sure that we curb inflation and we don't see a repeat of the 70s. So do I think we're going to hit a recession? Yes. My bigger concern is the banking industry, and hopefully We don't have another shoe to drop on there, but stay tuned and we'll watch the data and I'll keep you informed. You got questions, I got answers. Give me a call.